$10,000 may seem like a substantial sum of money. When it comes to retirement, it is obviously not enough. Don't underestimate the power of how much cash flow that $10,000 can bring you over time. If you invest this amount strategically, years later, it will help you to pay bills or even pay the down payment for your house. There are multiple ways you can invest $10,000 to improve your quality of life. In this video, we will discuss 5 methods that you can effectively invest your hard-earned $10,000, ranging from safer, low-yield options to potentially high-reward ventures. Let's get started. Number 5. Dividend stocks. Dividend investing is a simple method in which you can allocate funds to relatively low volatile stocks and consistently earn cash distributions from the company you invest in. You want to look for companies that have a track record of paying and increasing dividends over time. If a company is a member of the S&P 500 and has consistently increased its dividend payout for over 25 years, then this company earns the title of Dividend Aristocrat. These companies are great candidates for our investment portfolio. Caterpillar is a great example of dividend aristocrats because the company has been consistently increasing dividends for 30 years. How about S&P 500 companies increasing their dividend over 50 consecutive years? They are dividend kings. Colgate-Palmolive is a good example of a dividend king because it has had 60 consecutive years of dividend increase. Let's take Emerson Electric Company as an example. Ticker symbol EMR. The dividend yield is 2.30%, which means for every $100 you invest, you will receive a total of $2.3 throughout the year. The 10-year compound annual growth rate, or CAGR, is 2.31%, and the average share price return is 3.3% per year. 10 years later, a $10,000 investment would be worth $16,679. The annual dividend is $476, which translates to $40 per month. Waiting 5 more years, the investment would be $22,628. Now, the annual dividend is $725. This is equivalent to $60 per month. Investing in dividend aristocrats or dividend kings is a good move if you want steady income, but the growth may not be that high. If you are looking for higher payouts with more growth potential and safety, you might want to consider buying ETFs focused on dividends. Number 4. Dividend-focused ETFs. ETFs stands for exchange-traded funds. It is a basket containing a lot of different investments, like stocks, bonds, or other assets. So, the dividend-focused ETFs specifically hold a collection of stocks that pay dividends, all bundled up in one fund. Take Vanguard High Dividend Yield ETF, also known as VYM, for instance. This ETF tracks the performance of 450 stocks that offer high dividend yields. Now, its dividend yield sits at 3.07%, which is about the average. However, the 10-year CAGR for dividend is 4.19%. The share price return is at 6.1% per year. For a $10,000 investment, your return after 10 years would be $23,173 with an annual dividend of $1,047. On average, each month you would receive $87. This amount can help you to pay a bill or several subscriptions. One major advantage of investing in dividend-focused ETFs is diversification. By putting money into one of these funds, you are spreading risks across a wide range of companies. This can help cushion you against any big losses from individual stocks. Plus, the cost of owning dividend-focused ETFs is very low. VYM charges 0.06% per year for owning it. This is equivalent to paying $6 for every $10,000 you invest. Not just VYM, there are some similar funds out there like SCHD and DGRO with affordable costs as well. Mutual funds usually charge higher fees than ETFs. Trading ETFs is like buying any individual stock. You can buy and sell at any time. Number 3, invest in the market. If your goal is to prioritize growth over collecting dividends, then investing directly in the market could be a solid strategy. But what exactly is the market? Essentially, it is an index that reflects the overall performance of the stock market. When the majority of the stocks rise, then the index increases. Conversely, when most stocks plummet, the index declines. There are two indexes representing the market. One is the Standard & Poor's 500, also known as the S&P 500. This index tracks the largest 500 listed companies in the U.S. stock exchanges. It includes 80% of the market capitalization, making it a reliable indicator of the overall health of the stock market and, by extension, the U.S. economy. Another index we considered as the market is Dow Jones Industrial Average. This index tracks 30 large blue-chip stocks trading in the stock exchanges. These companies are in technology, health, industry, and energy sectors, providing a comprehensive view of the broader U.S. stock market and economy. All companies here are very mature, like Disney and American Express. The composition of the Dow Jones Industrial Average evolves over time to reflect changes in the economy and market dynamics. Underperforming companies are replaced with more successful ones, mirroring shifts in economic trends. For instance, in early 2024, Amazon was added to the index and Walgreens was removed. Back in 1896, the index included companies selling cotton and rubber, which were the crucial sectors at the time. These industries are like the technology information sector today. As the time goes, we are expecting to see companies like Nvidia or even Tesla join the ranks of the Dow Jones Industrial Average. In the past decades, S&P 500 had an average return of 12.02% per year, and Dow Jones was 8.7% per year. A $10,000 investment in 10 years would result in $31,113 from S&P 500 or $23,030 from Dow Jones. 15 years later, these numbers would grow to $54,882 and $34,950 accordingly. This type of investment does not require a lot of effort, and the return can help to fix your house. Number 2, invest in ETFs focusing on specific sectors. These funds are specialized in holding companies within one industry, like technology or real estate. The S&P 500 had an amazing 24% return in 2023. In fact, this growth is due to the Magnificent Seven experience huge capital gain. The Magnificent Seven refers to Microsoft, Amazon, Meta, Apple, Alphabet, Nvidia, and Tesla. All of them are in the tech sector. Among all 7 stocks, Nvidia had an outstanding return of 237%. Apple had the lowest return of 45%, which is still a remarkable growth. What if you only invest in a tech sector ETF in 2023? Let's take a look at 2 popular tech ETFs. Invesco QQQ Trust had a 55% return. Vanguard Information Technology ETF has a return of 53%. These are more than double of what the market offers. As a result, investing in a specific sector within a particular time frame can yield significantly higher returns compared to broad market investment. The real estate sector offers attractive dividends, but the growth is not that high. For a $10,000 investment in Vanguard Real Estate Index Fund ETF for 10 years, the investment would be $27,208. The annual dividend is $1,719 or $143 per month. How about investing in Vanguard Information Technology ETF? After 10 years, the investment would be $61,864. The annual dividend is $2,152 or $179 per month. As you can see here, the technology ETF may not yield that much in dividends, but the growth is very high. When we pick sector ETFs, make sure to consider growth but not just dividend yield. Number 1, we have the riskiest investment: growth stocks. Growth stocks can be volatile, but they offer the potential for significant returns. Take Apple, for instance. Over the past decade, Apple's average annual return is 26%, far outpacing the S&P 500's 10% return per year. A $10,000 investment would become $95,473 after 10 years. Since this is a growth stock paying dividends, but the dividend is too small to be considered, here's what we can do. We can invest in some stocks with high growth potential, sell it after making certain profits, then use the money you earned to buy quality dividend stocks to collect passive income. In this case, you would want to purchase $10,000 worth of growth stocks. Let it grow to $95,473 rather than owning $10,000 worth of dividend stocks for a decade. The capital gain from investing in Apple could be the down payment for your house. If you don't need to buy a house, investing the capital gain in dividend stocks would pay more dividend than simply owning dividend stocks since the beginning. This method has multiple steps and takes time to do research, but the reward is bigger. There are different ways to invest $10,000 for earning dividend income. Some are straightforward. The others may require you to do homework on it. Based on your unique situation, find the best investment strategy for you. Thanks for watching. Be sure to hit the like and subscribe button for more helpful tips like this. See you in the next video.